I guess the first topic of today is how do you take advantage of a bear market? Because ultimately, at the end of the day, it's, this is the cards you were dealt with. So how do you make the most out of it? And I have one interesting table I wanted to share with you. But before I do that, what are your first thoughts when I said that?
Every bear market is an opportunity. It's not necessarily an opportunity to buy things. It doesn't mean rush out and buy and get greedy and say, oh, I'm just going to try to catch the bottom. But it is an opportunity to regroup no matter what. So, for instance, if you have accounts all over the place and you don't know what they own, or you don't have an investment strategy that you can clearly articulate that you're a fan of, that you know how to implement, it's a fantastic time to make one, to see how it would have done up into this bear market and to implement that. If you've already invested and implemented a plan, you can look around the edges to see if there's anything that doesn't fit or you can replace, because the gift is most things are down, which means that you probably don't have a tax consequence to make portfolio changes. So to me, it's just a fantastic time to say, all right, what was our strategy? How did it do? Do we still like it? Do we want to keep with it? And for most people, if you really did your homework beforehand, you probably should stick with it. I don't mean it's a time to change strategies, but it is an opportunity to do so, especially around the edges, because you probably have the opportunity to harvest some tax losses. If you're not doing tax loss harvesting, it's a good time to look at whether or not operationally you can handle that. It's just a good time to take a look. It doesn't mean freak out, but opportunities abound.
The mistake I think a lot of people do is during a bear market, they recalibrate their investments towards a less risky outcome or less risky structure, and I think it goes against common sense, or I think common sense is in your favor here, that you should actually go towards more risky, right? So once the bear market happens and you're maybe in the middle of it and the stocks are down maybe 20-30%, and you're like, oh, well, I don't want to lose that amount of money next time, so I'm going to, dial back on the risk. That might be the wrong moment to do so. At the end of the day, markets do recover. And if you're dialing back the risk when the market is supposed to recover, your recovery is going to be muted.
I would agree. And I also think think about a portfolio that owns 3 funds. One is called stable, one's called moderate, one's called risky. And you've decided you want a third in each of those as an allocation. It's just a made up allocation. Year to date, risky is going to be down the most. So if you're rebalancing into that, what you're doing is buying more of the risky bucket now think of just a neutral rebalancing scenario. So I think that holds across the board, that now is not the time to just say, oh, I need to. Now is not when you implement your defensive measures. They've probably already not worked for you. So I agree with you. The riskier parts of the market. I mean, look, if you're looking at growth stocks right now, you're going to find massive discounts to what people thought beforehand. Does it mean all these businesses are 70-80% worse than they were 6 months ago? In my opinion, no, but some may disagree.
Yeah. And so the question is, okay, let's assume that you have this S&P is down 20%. You're officially in the bear market. So the question is, okay, what do you do then? What are your actions then? Your actions are, again, 3. The first one is sell, go to cash. Second one is I stay where I am, and the third one is I start whatever, I scrape around whatever capital I have, and I start to invest more. I don't have the data in front of me, but I would believe that investing more would lead to a better outcome. Maybe not always, but most of the time statistically would, right?
I would agree. I know that the stats are very bad for sitting around in cash waiting for a bear market. That doesn't work because bull markets are too long. You're just in cash for far too long. So you don't want to sit around waiting for a 20% drop to deploy. But yeah, I think intuitively that makes sense. Most of the time, markets go up.
So this is actually the returns after a really bad quarter, right? So it's not looking at all the bear markets, it's looking at returns after a really bad quarter. You had a precipitous quarter and what the returns look like. It's the S&P 500. So 1 year after the December 2008 fall of 21%, the market was up 26.5%. 3 years after, up 48%, and then up 128%. Now, it's not always positive. As you can see in December 1929, it was negative after 5 years, which is pretty harsh. The other quarter that you had in the 1930s was in June, also because it's the same time frame. But as you can see here, most of the data points that the recovery, it's pretty on average, it's pretty strong, at least the first year.
That is really nice, and yeah, those ones should scare you. This kind of goes in the negative 5-year return, always a possibility in any rolling chart of stock market returns. There are definitely 5 and definitely 10-year periods too, where you can still stay underwater. It's way worse for single stocks, like the Amazon. People talk about the Amazon one all the time, right? Like they're like, oh, yeah, I wish I'd have gotten Amazon in 1999. It's like you would have been in a horrific drawdown in a trough, as this thing says. For I can't remember what it is for Amazon. I want to say it's like 7 years.
I mean, that's to recover if you don't put any further investments in. But if you continue to invest, if you continue to believe in Amazon, it's hard not to believe in an index, right? So let's say you have $100 in an index that goes down to 50, sure. But if you continue to buy at 50 now, you start to actually lower cost average out. So it is from someone who's not retired and still earning money. That's a very good outcome. I mean, because you're actually lowering your cost. The market there's like an asymmetric. You're basically putting on an asymmetric bet. The likelihood is that it will recover, and as a result, you're just buying in a moment that's cheap.
This only really hurts. Like people think that people look at their portfolio. If you're not retired and you're not about to use your portfolio assets for something imminently, it just works differently. You very likely have a time frame where you're buying, and this is a net good for you. I know it's kind of a cliche. Young people, bear markets are good for you, but it's not wrong.
Also, there's another thing I think I would love to show here, which is the sectors. Which is, we've had really bad returns this year for some sectors. You can even look, from communication services. The year-to-date return is minus 31%. In the information technology, also the same happened, and the 10-year return has been pretty high. The one that's actually surprising is like energy. You had a year-to-date return of 54 or 50%, and it's barely up. Meaning that if you would have if you've taken the last 10 years and you had invested a lot in energy, you just broke even recently.
Yep.
This is from the bottom. So 1929, the bottom was a 6.2 drawdown. Reminds me of ARK. But I doubt ARK will have 4 returns like this. And then you had 2000 to 2002. That was a long one. If you think about it, that was a year and 2 years, right? Because you're going from March to October.
Yeah.
That was a long one. Long decline. But afterwards, tech recovered. That was the bottom of tech. Although from a multiple standpoint, I think the bottom was 2008, right? Because it recovered a little bit and then just completely got wiped out again in 2008.
I'm not surprised to see that the 70s still hurt you. Just a long, ugly market. That drawdown from 68 to 70 right there in the middle, 5-year forward return, painful.
You know what I think? So this is the one that actually it bothers me a lot. Was the inflation high in 1968?
I don't think so. I think it was mild in the late 70s. I think it was coming up, but not very high. Check me on that.
Inflation rate in 1968 was 4.19.
Mm-hmm.
In 1969, it was 4%. No, inflation in 1969 was 5.46%. It was slowly going up. I think it's the same situation as this time around, where the inflation starts to rise up. right? And
Ramping.
you had a long down drought. And the problem is in 1968, you're coming through, you're exiting like the high era of valuations, the Nifty 50. If I had to pick a bear market / recession that looks very similar to today, I would pick that one.
Gross.
Yeah. Except for I think we're in an accelerated pace right now. So my lesson is continue to invest. You will shorten the time between from pre-money peak to when you recover. Yeah, I think you can actually really shorten it substantially.
And don't reconfigure for defensiveness. Don't over reconfigure in that direction.
And that's not the solution. I think that will prolong the suffering.
But my confession today is that I made a fantastic buy in April of 2021 of Solana. I bought Solana at about...
Yes, my son, confess your sin.
I think $26 of Solana. And my sin, this is a great buy. Look at the chart. My sin is not going into this trade, this buy, with any sort of plan on what I'm going to do with it. Completely plan free, just having fun with the buy and watching what's happening, and no execution and no plan there. So the outcome is, as we sit today, Solana is now $31. I have round tripped this from 25 to almost 250 and back down to 30.
What does your wife say about this?
I have not communicated the details of this to my wife. She does have access to our joint balance sheet, so she could check this. But she doesn't. I don't think she really knows the entire extent of.
So this was the rise of Solana, right?
Yeah, that looks like that looks like it. What makes it worse is that I was DMing with someone on Twitter who I think is really, really smart and sharp, who has a ton. He had a huge bag of Solana, and he told me very clearly in his DMs that he was selling piece by piece in the high 100s. He's like, yeah, I've sold some and I'll sell more. And I took that and I did nothing with that information.
It's interesting how some people really say enough is enough. I think this is crazy. I'm going to sell. And then some people just get infected with greed or ignorance. I think it is. Because some people aren't greedy. They're just oh, I didn't know. I don't care. I just bought it and then forget about it. The market cap will go up to 80 billion. It's crazy. I mean, just think about these things in relation. Cap. Yeah, but in relation to other stuff.
Yeah.
$80 billion. What kind of enterprise are we talking about here?
It hurts. It hurts. We're talking about a coin. Yeah. Enterprise does not enter the...
I think I've told you this in the shows previously. I really do believe that it reminds me of the strong dollar problem. The strong dollar usually arises when interest rates starts to go up here in the US compared to other geographies. And so we're having a raising rates environment, right? We're raising rates. The 10-year, all the rates are going up in tandem. And so as a result, people who weren't investing in fixed income will take a second look at that and say, okay, well, this looks interesting. I might just put money in US dollars and buy some US bonds. And so they would sell their local currency, or they would whatever they would do, they would just buy US dollars to buy the bonds because the bonds are trading in US dollars. And so as a result, if the interest rates starts to separate between the packs, so if you have European and Japanese interest rates are much lower than the US, then there will be slow trickling, maybe fast trickling of funds going into the US bonds. And as a result, these financial waves or tsunamis create distortions in the market, and one of those distortions is that it weakens foreign currencies. And when foreign currencies are weakened, because people prefer dollars, it might create some volatility and some other shockwaves. And one of those types of shockwaves, and it happened in the past, was sovereign debt defaults. There's a saying, I guess, like in the macro people, is like, okay, great, the Fed provides liquidity, and liquidity is like a tsunami. It floods markets. And some of these smaller markets and like frontier markets, they're very small. They can handle an increase in capacity, like an increase in inflows. They just become overly expensive. But the saying goes around when the tsunami recedes. So when it goes back out, these markets just become empty. They empty out, really. And so in the 1980s, when Volcker raised those interest rates, remember, like, here in the history, like, oh, he raised interest rates. Yeah, all the interest rates went up. They really took it seriously in the US. They lowered inflation. But the result was that a couple of years after, you had a massive amounts of sovereign debt defaults, like in the mid 1980s, just because it weakened like these frontier markets enough that they couldn't handle they were very happy with excess capacity, but afterwards they couldn't handle the downdraft. And as a result, many of them defaulted, some of them restructured, but you can Google like the list of sovereign defaults, and you see like it peaked in like the mid 1980s. To me, the big question of all these cryptocurrencies this time around was, okay, these are new currencies. We don't really know how they behave, but are they like emerging markets? Are they liquidity kind of like they suck when the liquidity is plentiful? Yeah, when the liquidity is plentiful, they will rise very quickly. And then because they're like super discretionary, and when the liquidity dries out, they will empty out, essentially.
The analogy is good because all of them take themselves very seriously. And if you said, you are like a sovereign nation, they'd say, yes, we're very serious, just like a sovereign nation.
Yeah, they are.
We have our own things. But if they act like emerging markets or frontier markets or, despot nations, they kind of do in a lot of ways. Sometimes they'll steal from their citizens. They'll extract all the natural resources, and they'll go to a dictator, benevolent or not. And yeah, they are very subject to the tsunami of liquidity coming from real markets, developed markets, etc. So I think the analogy holds.
The good thing about this is that if you start to compartmentalize, or like if you start to like, okay, you tag them and say, okay, well, look, these cryptocurrencies behave like frontier markets. I'll just wait until the next time liquidity gets, it's like a wave of liquidity, because I know which assets are going to be very, very positively impacted by them.
This bear market most definitely has me questioning core, like, will Bitcoin survive this? No doubt. The wave of serious defaults and serious problems in the ecosystems is not a joke. 3 Arrows Capital, Celsius, Luna, these things really matter. Way too many people had leverage, and yeah, this could be a really long crypto winter. It could also be the last crypto winter where it just freezes down and all organic life disappears. More of an ice age than a winter.
And this is the problem I have with when discussing it with crypto people. Like, there's a lot of stuff that just normal markets, centralized markets, do better. Like, you don't need
way better.
Yeah, you just don't need it, and you need an actor that acts for the benefit of themselves, as a profit, as an incentive, and as a coordinator of resources. So do we need crypto for all these things? No. And I think it was you who said that the other day. Yeah,
does this need cryptography? Yeah, probably not.
No. And so you're going to have a lot of stuff dying out there. Sadly, there was a lot of wasted resources. I think a lot of people went into crypto thinking it would solve world problems. And
to wrap this up, your disposition looking forward on markets, on all risk assets, how are you feeling from cold to hot, bullish to bearish?
I do want to separate the cash flow positive and the cash flow negative ones. The cash flow positive, I'm totally fine. I'm comfortable holding them. I would say I would rather add to them than to add to the cash flow negative ones. So for the cash flow negative ones, I do want to see, I'm talking about stocks particularly, but I do want to see a plan to get to cash flow positive. It's key. and the stocks I've held or I'm holding, I've already seen CEOs slashing employees, and with a reason behind being we want to bring the costs. We want to rationalize costs. As a result, I'm more comfortable holding those companies. But I would say out of my portfolio, I have, let's say the portfolio is 20 stocks. I have about 3 that are cash flow negative, and 2 of them have announced plans to bring it to cash flow positive within the next year. And so I'm just looking to hear from the last one to see what their plan is. I would add, if I had more money, I would just continue to add more. And in my 401k, that's what I'm doing. For people who are watching this, consult your financial advisor. Make sure you're making the right decision for yourself.